Morning. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu, the Marketing Manager at Genghis Capital, and it's great to be here with you on the first day of March. It's the final month of the first quarter of 2021, and if you're anything like me, this is both exhilarating and terrifying. It's exciting that we're at the start of a new investment week and a wake-up call if you need to get started on your financial goals that you set for the year. But that's why we are here, to seek out those investment opportunities in the local and global financial markets. It's always wonderful to see returning veterans to our webinars. It gives me a thrill, and the whole team too, to know that this Monday sessions are offering new value. It's also humbling to see new names on the attendees list. That you decided to register and join us today is indeed a pleasure. The Genghis Investor Briefing format is as always. We'll have a microeconomic and fixed income overview from the head of research, Churchill Ogutu. Then making a triumphant return as the newest member of this briefings is Kevin Ngige, Senior Equities Dealer from the Genghis Securities Department. And then we'll have Mathew Kabeere of EGM Securities, FX Pesa, give us an overview of the global markets. We're all abuzz with Spotify services coming to the Kenyan market, but now is the time to also say that you can also trade in Spotify shares as you bob to the music offered on the platform. Remember, Genghis CDS clients have a simplified access to FX Pesa platform thanks to our partnership with EGM Securities. Ours is not a one-sided affair. We welcome all attendees to use the Q&A function to send in questions to our expert panel and to use the chat box for any comments or ideas. Do take full advantage of the session to get answers to your financial market questions. That's enough from me. I've been looking forward to this, as I am sure you have too. Churchill, the floor is yours.
Thank you, Damaris, and welcome back from a one-month-long vacation. I hope the Caribbean was kind to you. So welcome back. And happy new month to all our participants. And for the February 29th birthday babies, happy birthday to you too. So let me share my screen. I hope I have the rights to do it. Awesome. So as usual, I'll take you through the review of last week, and then you can get into what's the outlook for this week before we get into the fixed income, and as I pave the way into the equity side. So last week on Friday session, the Feb 2021 inflation rate, the data came out. The overall inflation print was 5.68%, slightly up from the data that came out in the month of January. Actually, the data was around 5.79, not 5.68%. Core inflation was at 2.2%. Food inflation was at 6.9%, slightly lower from the 7.4% that was there in the previous month. And the fuel inflation edged up to 13.8% from the prior data. Let me just speak about the fuel inflation. We've been seeing some uptick just based on the Energy and Petroleum Regulatory Authority, the last fuel pump price review, where there was some uptick, where there was an uptick in all the three commodities. And that is stemming from the fact that global oil has rebounded. Let me just steal the thunder a bit from Matthew's presentation. And to be sure, we see that last year around April, global oil prices was around $19.33. And right now, by the end of January, which was now the basis of the last review, the prices had come all the way to $55. So that was like a 190% increase in global oil prices. For the month of February, last week it closed at around $6 per barrel. So that is also another 9% increase month on month from the close of January. So it seems that there's that upward pressure in fuel, global oil prices, just based on the renewed growth optimism across the globe. So that so far, we haven't seen it having a knock on core inflation. Core inflation still remains subdued at 2%. The overall inflation at 5.8% in February that is still within the target or the band that CBK monitors between 2.5% to 7.5%. So we think that based on this data, we don't think that in the MPC meeting at the tail end of this month that CBK will be able to action just based on the inflation print that we've seen so far. And coupled in as much as this, that cost inflationary pressure from a full inflation perspective, it hasn't had that second round impact on even the core inflation so as to be able to warrant some action from the MPC. So that's one of the things that we picked out from the inflation print. This week, we just monitoring the Stanbic PMI data for February. The last one that is for January was 53.2, and there's been a gradual uptick, I think, from October last year. But we'll just see the actual print, which will be out this coming Wednesday. We were expecting the fourth quarter last year's unemployment rate to be out by last week. That hasn't come out, so that's still what we are monitoring. In addition to the quarterly economic and budgetary review that as at December last year, that was meant to have been released like 2 weeks ago. But having said that, I think this review mirror, even if it's released, it will be more or less outdated data. We've seen in the last webinar where I walked you through the January revenue and net expenditure data. So it has that data by itself has superseded even what you're waiting from this quarterly report. But nonetheless, that is another key report from National Treasury that you're still keeping an eye on. Moving on to the fixed income, last week, so a second consecutive week whereby there was a decline in performance. Last week's was around the order of 9% week-on-week decline to 15.1 billion. Trades were majorly on the infrastructure bond segment. And on the T-bill side, we are seeing a performance rate also rebounding at an overall performance rate of 132%, which in aggregate terms is close to 32 billion. And we saw that yields edged up across the tenor. And to be sure, we've seen that from the start of this year, yields have gone up 0.3% on average across the three tenors. Moving on to the liquidity indicators, last week we saw an increase rather in the average interbank 0.19% to 4.2%. And on the open market operation, CBK was majorly biased towards mopping up liquidity. So on one side, we are seeing that just looking at the interbank market, what is telegraphing is that there's some tightness in liquidity by the sheer fact that the average interbank rate went up by 0.19%. Sorry, I put there negative 0.19%, but it's actually plus 0.19% to 4.2%. But on the other hand, we are seeing that CBK is actually mopping up. So it's pointing to some mixed signals in terms of liquidity trends. Nonetheless, the outstanding term auction deposits as at the start of this week is 22.5 billion, which is a weighted average rate of 5.996%. In terms of net domestic borrowing, from our estimates, we are seeing it's 313 billion. That's inclusive of the overdraft facility from the CBK. That represents 58% of the revised 540 billion target in the current financial year. So we're just having 4 months remaining in the current financial year, and that's where we're standing at this point in time. Moving on to the week's trade, this is ideally a tactical trade whereby we are pitching a buy on FX D1 2025. So this is a 5-year that was the first 5-year paper that was issued last year. The levels we're looking at is currently between 10.55% to 10.65%. The market is still waiting for an announcement on the primary, on this month's primary bond notice. From what we gather is that this committee that meets prior to the announcement of any monthly bond issue. So that committee met last week on Friday, from what I gather. So an announcement is imminent from that committee. So it's also an opportunity for, just against the backdrop of the uncertainty that is happening, and what the strategy that investors mostly use is now to look at the short end of the yield curve, or look at those bonds that have a short time to mature. So that's, it's technically called reducing duration. So that's what we are seeing in this week's trade. So let me just cut and raise for our equities dealer, that's Kevin Ngige, just walking you through the recap for last week before I invite him. From the indices side, that's the Nairobi All Share Index, declined marginally, 0.1%. NSE 20 share went up 1.4%, so that's mixed signals from the indices front. Turnover edged up, bounced back in a massive way, at 1% to 3.2 billion from the previous, I think, 1.8 billion, thereabouts. Nation Media was the week's top gainer. To be sure, it went up by 23%. And the biggest is a no-brainer, the announcement that came just at the start of Thursday's trading hours in terms of the share buyback is the proximate cause of this bounce back. And we saw that between Thursday up until between the end of comparing Wednesday's close and Friday's close, we are seeing like a 21% jump in Nation Media Group shares. But for the week, it closed at 23.3% up. CSC Insurance, another top gainer, up by 8.5%, similar with Unga Group, up by 8.5%. Unga Group announced its first half of this financial year's earnings last week with a profit after tax of 83.5 million. Top losers, TransCentury, NBV, that's Nairobi Business Ventures, and also Standard Group closed the week in the red. Let me just comment about the foreign activity, whereby we saw participation by foreigners totaling 59.7%, and with net inflows of 11.8 million. Foreigners accumulated on Safaricom stock counter, and they exited on EABL, KCB Group, Equity Group, and also BAT Kenya. The top traded counters by foreigners in that order was Safaricom, EABL, Equity Group, KCB, and BAT Kenya. Let me temporarily stop here and invite Kevin just to give us some snippets from the equities trading perspective. So Kevin.
Thanks, Churchill. I'll just share my screen and continue the presentation.
I share my screen, or?
No, I'll share mine. I'll share mine.
Okay. Okay.
You can all see my screen?
Yes, Kevin, we can see. Maybe you could go into presentation mode.
1 second. How do I go into presentation mode?
At the top, above Home, where there's a Home tab, at the top there is
Okay.
that thing, yes, icon, technical term. There you go.
So yeah, Churchill has gone through the overview, and NASI was little unchanged. As you can see, it was just down 0.1, and the All Share was up 1.4%. So there was little movement on the indices. I think the foreign activity was generally mostly on the blue chips. We saw foreigners exit EABL, we saw some foreigners exit on Safaricom. We know there's only 5 days, including today, until books closure. So we're going to see some activity up until I think Wednesday, when anyone who's buying into it now will not be eligible for the 0.45 cents dividend. So that's quite something to watch during the week, especially today and tomorrow. Others are anticipating Safaricom might touch 40. I don't foresee it making such a high jump, but it will be one to watch today and tomorrow. So Nation Media, as Churchill has mentioned, that talks about the share buybacks. Of course, the share has heavily been hit. I think it was one of the hardest hit media houses if you're looking at data since March last year. That's during the pandemic. So I think the board agreed. They've not yet given the full details as to how they're going to do it, but we foresee them coming into the market for blocks, and that would see some 10% gains in the interim. Foreign activity, I think Churchill has touched on that. Safaricom, we expect accumulation today and tomorrow. I don't foresee that going on to Wednesday due to the T+3 trading rule. EABL, we saw some exits last week up to levels of 165. It was predominantly foreign exiting, local buying. We're not sure whether the locals would be back buying this week, but it's something we'll keep an eye on and update. Heading over to the NSE versus peers, we see NSE was up 8.73% compared to an African average of 1.7 year to date. Again, give most of this credit to Safaricom that has really rallied the market. I was just looking at data and Safaricom was 66.7, that's about 67% of all trading activity last week. 17% went to banking, and I think another 16% went into manufacturing, where we saw some action on BAT and EABL, to mention but a few. So this was a very good performance year to date compared to our peers. So corporate action this week, as I mentioned, Safaricom closing their books on Friday for the 45 cents first ever interim dividend. Again, due to the trading rule T+3, we anticipate action today and tomorrow, not so much on Wednesday and Thursday. BAT Kenya 41.50 final dividend, 16th April, and Kengen, sorry, 30 cents final dividend, 29th of April. Yeah, that's it for me. Thanks, Doris.
Thank you so much, Kevin. I think now we can move to global markets. Mathew, the floor is yours.
All right, good morning, everyone. Happy new month. Happy to be with you. And let's check on the global markets and see what we have there. Sharing my screen. So last week, we start with last week recap. And of course, oil prices rose to the highest levels since the beginning of 2020. And of course, looking forward to the recovery as it's happening, the oil market pushing up and up. Both yields jumped to fresh highs as US indices struggle. And of course, gold continues to slump. Federal Reserve, of course, there's no rush to raise the interest rates for the US economy, of course, as they gradually heal from the COVID-19, and that's making a little bit of a check on the growth levels, because remember, we're waiting on the stimulus, and again, recovery on the pandemic is something that still reeling on. That's last week. Now, this week we're expecting we have a very busy economic calendar. Of course, we have RBA rate, OPEC meetings, and many more, and we're not expecting any big change on the Reserve Bank of Australia. Today they have something about, this week they have something about the interest rates, the policy rate, and of course, looking at their consensus or what's expected in the market, we're not expecting much. It's like a 0.1%, looking forward to maintain that. Euro area, UK, US, we have the PMIs. That's going to be big news, of course, likely to affect the movement of those currencies. And my colleague Churchill spoke about the oil market, and of course this week again we're expecting very important meetings with for the OPEC and JMCC, and this is where they're going to discuss about the cuts which have been prevailing, the supply cuts, right? And of course, remember, they are going to try and manage that and balance it between production and the consumption. Because again, if they oversupply, then it's going to cause a slump of the oil prices. They have to manage that one. So we have to wait and check out what really comes out, the data which comes out from that meeting. US going to look out for the job markets report, and that one will determine how the dollar will perform this week. Of course, looking out for the jobs, expecting a rise in the job. If it hits above 100,000 mark, then it will be something to look into to support the dollar. And of course, expecting a rise from 6.3% to 6.4%. So check out for the calendar. Of course, PMIs lined up there, the US, Canada, really a very good indication on how whether the economy is making a rebound. The economies are making a rebound in the US, a rebound from the low levels of economic activity. And check out for the Australian cash rate. Of course, I've mentioned earlier that looking at the previous and the consensus, it's like on a 0.1. If it maintains as that, then we are likely to have to maintain the current trend there. So check out for that one. And on Friday, we have the jobs data. Of course, and on Thursday, for the traders of oil, check how you can benefit from that. It's really, really very important. But a sneak peek is that, of course, as the economies are bouncing back from the difficulties, of course, which we've been having, we're looking forward to at least an increase in demand, and that might push the oil prices higher. But again, remember that the OPEC and all those oil producing countries, they're looking forward to at least try and increase the production a little bit or ease on the cuts. But again, they have to balance it with the production. So depending on what happens there, we might see the oil taking a different trend all along. Maybe it could be kind of ranging or maybe trending upwards. We might have to watch for that data. Really very important. So products to watch this week: euro dollar, and last week closed on a really very bullish mode, but again slammed towards the end of the week, and we have an uptrend there. So waiting to see whether the currency is going to, the pair is going to break below or to maintain that support level. If it breaks below the 1.2 level, which is really a strong support level, might see it to the downside of 1.19 all the way to 1.18, where we have the market was on a kind of a range bound. Okay, and this is actually due to the risk on environment that we're getting into. Remember, the euro, these are currencies that are considered safe havens. And when you're getting the risk of, now you see the traders want and investors want to venture into the riskier markets. And if the risk of sentiment continues, of course, alongside with the recovery and the distribution of vaccines, then of course we might continue seeing a pullback of some sort or a reduction of the momentum on the upside. So again, on the US, elevated US bond yields. And now this week, looking at the PMIs, as we've seen, and US jobs data, very important to help find the direction for this pair. Again, as we're seeing that nice pullback there, if this pair is able to breach the previous week's highs, we are likely to see it challenging the 1.23 levels. And of course, those are technical levels that we need to watch out for. If they are breached, then of course we're looking forward to a continuation in the direction. That's for euro dollar. Nasdaq, checking out on the stocks. Last week there was really a slump on the stocks, and that one is due to the rising yields for the bonds. Okay, but again, it's a time when there is a mixed optimism and pessimism. Remember, US, we're expecting release of the stimulus. It's really like not coming up that fast as the investors are expecting. So that's why you see the markets are slumping currently. When you're checking out on that selling pressure, we see that the down move has been capped on the 1.26 level. Yeah, trying to rebound there. So if that level breaks to the downside, then you might expect to see the price moving to the lows of 12.248. Sorry for that, 12.248. But again, as the economies are rebounding, if it breaches the 13,100 levels, might say challenge the moving averages. There you can see it's trading below the moving averages. That's an indication that, of course, we are a little bit on a bear market. But on check on the momentum, again, it's little by little taking a rebound. So again, if we have the momentum going up as the recovery from the coronavirus is coming up, then might check out to see a long-term trend on the stocks. Of course, you know, when the economies when this coronavirus thing is really not very challenging as we're looking forward into the future, it means that people or investors will want to get into stocks, and that might keep the index performing better and better. But for that one, we have to wait and see the role, of course, of the stimulus when it's gonna come, because we don't know when that is going to be, but have to watch on the key data coming out from the US side. On the stocks, remember, we don't want to keep on glued to the currencies markets alone. On the stocks, of course, you always need to check out on the expected earnings and any corporate reports being given out for those listed companies. And on Monday, we have these companies looking up to announce their earnings report, the Neo, Zoom, right, Taylor, Marvel Tech, and you find all this information. Check out on their release data, might be very important, and you can take out what you can take from the markets. Companies based on the dividends announcement this week, of course, we have all that lined up for you. Goldman Sachs was expecting a dividend of 1.25. Check out there. All that. Cash dividends going up high. Good expectations. Qualcomm, FedEx. Check out for that, ladies and gentlemen, and see whether you can get an opportunity to get in and ride. Of course, as we're expecting the rise of the economies getting up and getting even stronger and economic activity increasing, of course, we might be looking forward to have good opportunities out there on the stocks. Remember, it really gives an incentive for the traders. So that's for it for me this week. Looking forward to hear from you on any questions you have. Over to you, Damaris.
Thanks so much, Matthew. We do have a question directed to you from Ian Wangai. He's like, what are the best timeframes to trade? Because with M15 chart, it becomes hard to reach at patterns. Also, with the higher timeframes, does one require larger capital?
Good question, Wangai. The best time frame to trade depends with your trading strategy. If you have a trading strategy that you've designed well for a lower time frame, that's nice. If there's one that you've designed well for a higher time frame, that's the best. But my advice is, and the best practice for traders is, have like a top-down view of the market. Check out what is happening on the higher time frame. That's where you're likely to pick out where the smart money is going, because they really don't have to check out on lower time frames. They will be mostly on the higher time frames, because these are people who are holding positions for long. So my advice is check out on what is happening on the higher time frames, like 4 hours daily, right? And then you can get to lower time frames like 15 to manage your trades there. Check out on where you can enter after, of course, understanding the trend which is happening on the higher time frame.
Okay, thank you so much, Matthew. And Ian, I hope that answers your queries. Next, I have a question for Churchill and Kevin. The first is from Titus. Titus is asking, which stocks can you say are deep value stocks at the moment?
Thanks, Damaris. Let me just tackle that question. As Genghis, we have 3 different portfolios. The first one is now the momentum. We have also the growth portfolios, and lastly, we have the value portfolio. So ideally, the deep value stocks land on that portfolios, whereby we have EABL, we have Kengen, and we have Kenya Re. So for EABL, primarily what we have priced in and to make it more a value stock is the expected rebound in their financials. Looking at the trough that was there in the second quarter last year, we saw a bounce back in its first half earnings. That's between July up until December. The sales revenue jumped up close to 55% from the prior half year period. So we are ideally banking on, even by the time the full year numbers will have come out, we expect that there'll be that gradual reopening of the economy. Ideally, EABL was hit by the shutdown of bars or these curfew hours, which had a major dent on EABL, but we expect that gradually that risk will ease off. So that's one. We have a target price of 194 shillings. Right now is around 166 shillings. So we're looking at an upside of 20%. The other one is on Kenya Re, whereby we are just looking at it from the value component of it. If you compare the book price to book value of Kenya Re against the other insurers, we are seeing that there's still some upside potential on Kenya Re. I think it has a book price to book ratio of 0.2 times multiple, and against an average of around 0.5% amongst the insurance sector. And then finally, we have KenGen. We have a target price of 7 shillings and 11 cents. Actually, KenGen released its half-year numbers last week, Thursday or Friday session. And what we picked from that number is the headline number, the revenue came off slightly, but the net revenue showed a near 8% jump just based on its revenue diversification. But bottom line, we saw that its net income was around 5 billion, which represented around 73 cents per share. So as an investor, what you are looking at is as you take this, just general commentary, as you take an ownership share in a company, you'll ideally be interested in that earnings per share. So for KenGen was around 73 cents, slightly lower than the prior half year, last year's half year period, but nonetheless it was quite good. So we are still having those value stocks, EABL, Kenya Re, and KenGen. Yeah.
Thanks, Churchill. I've taken notes. And since we're talking about insurance companies, is this question from Kamau? I'll start with the second one he asked. He said that Kenyans kept off hospitals during COVID, meaning insurance companies saved on premiums, but shares of listed insurers don't reflect that. Why? I think maybe you'll elaborate, but I have an issue with the first assumption. So maybe you could tackle that. And then his second question is, Samia has land valued at 7 times the company's current value. How come this is never reflected on share price? So those are the two questions from Kamau. Thanks.
Well, or Kevin should go first. I think he's ready. Or
Kevin, we saw you. You're ready. Your mic. Thank you.
Can you hear me now?
Perfectly.
All right. So what was the first question again, please?
The first question was from Kamal. He's saying Kenyans kept off hospitals during COVID, meaning insurance companies saved on premium, but shares of listed insurers doesn't reflect that. Why? Then the second one was on Samia has land valued at 7 times the company's current value. How come this is never reflected on its share price?
Okay, those are two beautiful questions. I think I'll take the first one on insurance and maybe leave the fundamental one to Churchill on Samia. So one of the challenges when it comes to trading in the NSE is access to liquidity. And one of the challenges that I think insurance companies have faced, despite that government, for instance, has a significant holding on Kenya Re, which is the insurer of insurance companies. So one of the challenges we've had is the uptick by foreign investors. And as such, like I mentioned earlier, Safaricom, for instance, took 66.7, call it 67% of all trading activities last week. The next position was taken by banks by around 17%. And then manufacturing companies like EABL and BAT. So insurance, and one of the problems, I think it only accounted for around 1.16% of all trading activity last week. So the market is not deep enough, or rather, two things come to mind. One, we were speaking to our foreign clients a while back, and one of the things they mentioned is insurance is not well understood. It's a very broad subject. And then that becomes even worse when you're talking about African insurance companies, and for that matter, Kenyan companies, where not so many analysts are looking at this, especially at a global level. So that affects the trading activity in terms of uptake. And as such, when foreigners are coming, you'll mostly see them on blue chips, and those are your banks, the top manufacturing companies, and the telco. In terms of even looking at indices that global investors look at, for instance, the MSCI index, you'll find that none of our insurance companies are listed. So, I mean, it has to take a very curious investor to now look at the performance and the numbers of insurance companies, regardless of their performance. Thank you.
Thank you so much, Kevin. Now, Churchill, maybe you could tackle the question on some.
Yeah. Also, let me just piggyback on the first question that should be Ian. But I think that by and large, that could be anecdotal evidence that you hear that stories, people are shying away from the hospital. So that's one side of the coin. But the other side of the coin, you could find that even the few people who go to the hospital, you find that even their cost might have gone up just looking at the COVID-19 issue. But we haven't seen the actual data in terms of to support that anecdotal evidence that few people went to the hospital during this COVID-19 period. So I think once the industry starts come out, we know that this month, the earnings seasons will start even getting some visibility on their full year numbers. And then it can tell us that ideally whether their revenue or their claims ratio was lower than the prior years. But as of now, we are seeing that it's more of anecdotal evidence that we're seeing here. But nonetheless, we are seeing that in terms of strategy, you find that even most of the local insurance, they are not sticking to their core business of insurance. Some of them are into equity investments. Some of them are into property investments. So you find that they have diversified their portfolios away from their core, either non-life insurance or the life insurance. So that's another thing just to somehow steady their ship. But nonetheless, on the other side of the coin, this diversification into, say, equity investments or portfolio investments has also brought in the volatility in some of their pricing. So that's another issue that just to disentangle as one looks into the insurance sector. The issue about Samia, we don't cover it in the play, but just to comment about Samia as a whole, we saw last week, when it came out with the business strategy update. Last year, around April, it said that it's getting out of its tire business, which is synonymous with Samia. If you just think of Samia, it's just their tire business and the Yana brand to be particular. But so last week's I think should be last week, but one's announcement is saying that it's getting back to the tire business and also looking at into the real estate portfolio. So that fits into Ian's second question about what's this land. And I believe they could be now positive sentiment because now they brought to the fore that this is their strategy going forward. Real estate on one hand, and also the tire business on the other hand. So we're likely to see that even investors will positively react to that news and reward that company going forward. So back to you, Damaris.
Thank you for that comprehensive answer, Churchill, and as well, Kevin. Now, Mathew, I want to forward you the question for Bitcoin, because for some reason, I feel like you're the man for this. Peter Irungu is asking, what's your opinion on Bitcoin, both as a currency or asset with current acceptance among big companies? What's your 2 cents on that, Mathew?
Well, what I can say about the Bitcoins, really, it's an up and coming kind of an asset at the same time as a commodity and a currency. Remember, this is backed up by technology, and I've been reading a little bit wide on it, and it's like coming up to a new normal. Remember, it's like we have the traditional way on the financial system, and now it's like coming up with a little bit different kind of view or approach into the market. And some of the things which have been argued about Bitcoin is the transparency kind of, and reducing the bureaucracy that we see in the financial system. But again, on that, the acceptance of Bitcoin both as a currency and as a reserve of value is really debatable, because many economies and most of the economies globally have not really accepted it as much. And currently, the rise in value of Bitcoin is based on the scarcity and really supply and demand. We've been seeing that over the past few weeks, or maybe a month or something like that, just tweets by big investors and big companies were really making the price of Bitcoin to go up. So it's clearly based on the sentiments in the market and the supply and demand in the market. So again, speaking of the entry of big companies and big investors there, it might be an indication that it's getting or gaining acceptance. That's what really matters. But acceptance as a currency or as a commodity sort of, because people again are thinking of looking forward into in the future having cryptocurrency like in the position of gold, like a reserve of value. But again, something that we might want to see based on whether it gains acceptance from various jurisdictions in the world. We're talking about economies accepting the worldwide, and big investors getting in. That's what we're looking up to. And maybe just to mention, it's really slumped over the last. Let me check out real fast. It's really slumped over the past week, right? Going all the way to the lows of I think 44,000, all the way from the highs of 58. So it's really a very volatile financial instrument, and we can just keep watching on that space, see how far we're going with it.
All right, thank you so much, Matthew. I want to bring Kevin to the conversation, because I know Kevin has also talked about countries are looking towards introducing their own cryptocurrencies. Kevin, would you like to contribute?
Thanks, Damaris. I think maybe what I just have to say is to buttress what Matthew has said. I mean, he's the pro. But looking at the question one was, I think the client expected us to discuss in terms of it being accepted as a global currency. I don't think we have capacity to talk about that. It's only a few weeks ago, I mean, we tasked CBK on that question, and I think the trajectory that most CBs have taken is to develop their own digital currency. For instance, we saw China now claim they're ready. I think they tried to do a few tests over the last 2 weeks, but it's a project that has taken them 6 years to then accept their own digital currency. So this is their own central bank-backed Bitcoin, you know. So yes, they are yet to go live. So we are yet to learn from that. Lagarde of the European Commission Bank, president of the European Commission Bank, said they'll be ready in around 4 years. But to answer the question, no, Bitcoin is not accepted as regular tender. It has not been backed by any central bank, but we have seen a couple of developments, especially in the US, for instance, with a coin called Pax, you know, and Pax is these are what we are calling stable coins. These are coins that they are pegged to the dollar. So depending on the movement of the dollar, then the coins will tend to reflect that price. So these coins have become heavily accepted. We've seen that even in the derivatives world, because the value of these coins is not as volatile, which has been one of the biggest challenges with Bitcoins. There's no hard assets, say, during the gold-backed era. There's no gold that is really supporting prices. And really, we've seen them being touted as meme coins. You know, once Elon Musk comes to the market and tweets something about Doge, we've seen it hit 20, 30% up. You know, his share is from his Twitter account for a few days, and the same investors again shoot it down. So it has become sort of a game stock, sort of a Reddit kind of stock. Yes, just to answer the question.
All right, thank you so much for that. You know, I always get interested when these conversations take place. We're always talking about US, Europe. We really don't talk about Africa. It's like Africa, we're not even in the realms of dealing with that. because I actually read an article, the Central Bank of Nigeria, I think, had issued a statement about Bitcoin and how they're cracking down on its use. So when will it even be a conversation about implementing in Africa our own kind of cryptocurrencies?
The biggest challenge about cryptocurrencies that central banks are unable to answer and they won't accept publicly is, will the cryptocurrency introduced, will it run parallel to fiat? So will it run parallel to your dollars and euros and pounds? No one is unable to, and if it will, how will that process go? So no central banker is able to answer that, including Christine Lagarde, yeah? The president, again, as mentioned, of the EU. When you come closer home in Africa, I mean, we tasked CBK and clearly they said, we have other priorities. So it's about prioritizing. And they said right now it's about COVID-19. We saw the vaccines will be here this week. So it's all system go with making sure the populace is healthy, is vaccinated, and they're safe. Then with time, he mentioned that we're going to address cryptocurrency. Though that is almost backtracking to the words they mentioned sometime last year when they said, and when the US, and they're quoted in one of the local dailies, in terms of they're also relying on the blockchain's power to make sure that we are also set up and you're not running far behind when the other developed ones are taking off. So it's been, as Mathew mentioned, it's a matter of how will it run again against the fiat. It's a matter of privacy because Bitcoins are supposed to be ideally decentralized. So there's no central agency controlling price, controlling circulation. We've seen how it's mined or earned. So I think Africa, we're really far off behind. I don't think we have the resources, the expertise, or the chance to prioritize it above our other needs.
Okay, thank you so much for that.
I'd like to...
Yes, Churchill, how could we leave you out? Go ahead.
Anyway, from where I sit and looking at this central bank's foray into the crypto space, I'm saying that they have noticed, they haven't ignored this traction that the cryptocurrencies have done. So that's where we're saying that this talks about digital currencies being introduced by the central banks. Of course, agreeing with what Mathew and Kevin have said, is like introducing that is a way of centralizing what is now being centralized. So they have seen that if the crypto just gained traction, you see more and more people getting into that bandwagon and jumping ship from the fiat currency. So they want to centralize what is now being decentralized, just with their forays into the digital currencies. How it will work well, or how they'll be able to even gain some credibility with that, is another thing altogether, but something worth watching. So back to you, Damaris.
Thank you for contributing to the discussion, Churchill. So I'd like to tackle Bernard Osongo's question. Bernard is asking, how does he go about opening a money market account for a limited company? And can his company also obtain a CDS account for purchasing of shares? So yes, Bernard, companies, corporate accounts, you're able to open both a money market fund and a CDS account. I'll reach out to you via the email address that you used to register for the webinar, and I will put in copy the client relations team. They'll be able to share with you the account opening forms for the corporate accounts. Corporate accounts can open an account for Helaimara or CDS using our mobile app. So it still has to be an application form, but it'll be emailed to you and you can submit the details or share any questions you may have. Since I'm fielding questions regarding Genghis products, I saw in the chat that Ben Mark had asked, or rather he had stated, I have an account with Genghis. I would like to be guided on how to trade on the platform since I'm still green. I don't want to just deposit money and let it be there. So Ben, we're happy that you have an account with Genghis Capital. So depending whether it's a CDS account or a money market account, you'll be able to trade using the platform, the Jacuzzi app. For the CDS account, we share the research that Churchill and his team produce. The client relations team is also available via chat in the app, so you're able to ask them any questions that you may have. Churchill and his team are also reachable via the email research@genghis-capital.com. And once you have the information or knowledge that you require to make your decision on what stocks you want to trade in, you can execute that using the buy and sell functions within the app. If your account is a money market fund, it's as simple as navigating to invest, unit trust, and then clicking on buy in order for you to buy your units. And if you want to withdraw, you can also initiate for both accounts within the app. So I'm seeing here you say you would like to trade on the stock market. So yeah, that's very much possible. If you have any other specific questions, I'd urge you to call our team on 0709-185-000, and they can walk you through it. I'll type the phone number in the chat just in case you don't have it. So thanks for that question. I've seen a couple of more, or rather one last question come in from Ian, and I think this is back to the cryptocurrency conversation we're having. He says Nigeria is the second biggest crypto market in the world. Recently, we had the central bank ban any crypto market in the world. Okay. What I think makes central banks not take is the transparency, because numbers like trading volumes are not readily available. What possibly could happen in central banks could happen in the use of private blockchains, in which they do have control over the said entity as compared to the decentralized blockchain as we have with Bitcoin. Ian, I feel like you must be a crypto trader. These are my intuitions. I think this conversation perhaps is best had one-on-one with our team. So I will loop you in on an email with Kevin Ngige, and you guys can continue this conversation online. And perhaps we could have Kevin's, Kevin, you know your Friday webinars we're having, maybe one of them could be dedicated to cryptocurrencies, because definitely there's an interest to it. So I think I'll just have one last look to see if there are any other questions. I think Harry has an admin issue. Harry says, I'm currently out of the country, but I have an account and use the app, but I don't have access to stock market. Can Lydia from your team, she has emailed me before, to contact me via WhatsApp, since I'm not in Kenya currently? Okay, Harry Rongoma. I trust you mean Lydia. I'm not entirely sure which Lydia, but I'll just put you in loop with the client relations team, and they'll be able to assist you further. I believe we will come to the end of this session. So I just want to say a big thank you to Mathew for joining us for this past 1 hour. A big thank you for Kevin for joining us for this session yet again. A big thank you to Churchill. Thank you so much for covering a very big spectrum of our discussion. What I'd like to mention, and I see Dennis Chomba here says, kindly share the link for the Friday's webinar. Yes, there's a Friday webinar. We are launching something new called the Genghis Monthly Financial Chat. So this is where Kevin Ngige will sit down with different guests and talk about a wide range of topics. So for this Friday, we're going to be reanalyzing the playbook. As I'm sure many of you remember, we launched our playbook in January. So we are having Bulls and Bears, a Genghis playbook story. It's on Friday, 11 to 12. The link is available on all our social media platforms, but before I end this session, I'll also type it in the chat if you just want to click and join. So thanks again. We are always happy to see you. We hope we'll see you on the Friday session and again on our Monday session. Have a great start to the new month, and reach out to us in case you have any questions on email, on social media, anywhere you find us. We'll be happy to have a discussion. Thanks, guys.
Thank you. Have a successful month, everyone.